Ladies and gentlemen, welcome back to the channel. Netflix reported earnings last night that came in better than expectations almost everywhere. This was not a jaw-dropping quarter. This was a good quarter. This was an as expected quarter. And the stock is up 10% today. I want to talk about what this means for markets. This clip from CNBC says earnings expectations are way too low and markets will swing higher, says HSBC's Max Kettner, which we will get to that clip in just a moment. I do think that's pretty obvious given Netflix's earnings. Expectations have been plummeting for this quarter earnings, for Q4 earnings, and even 2025 earnings, but yet markets just continue to go higher. I think there's a reason for that, and I've figured it out. The truth of the matter is valuations don't matter anymore. And let me explain this. Now, I gotta say, I'm kind of flipping in a sense. Now, I do want to start off with saying I have not been in the hard landing nor soft landing camp at this moment, and I'm still not changing that stance. But I do think from the market's perspective, it doesn't really matter. And I think by the end of this video, you'll agree with me. First off, hard landing, soft landing. The weirdest dynamic has been this market is really twofold. There's areas in which that have not priced in any recession, like big tech and some of your AI names, the names that have the largest market cap weighting in the S&P. And then there's other areas that have priced in a lot of recession risk. Dollar General, Nike, consumer discretionary, defensives even, have priced in cyclicals, let's call it that. Just group them all in the cyclical category. They've priced in a lot of recession risk, but the markets have not priced in this recession risk by and large because the companies that are really represented in the S&P, like 40% of the weighting in the S&P is big tech, they have not priced in a recession. And that's because these big tech names are seen as really recession resilient. They're really not dependent on economic activity to continue to grow their earnings. At least that's what the markets say. So I think the expression that I've been saying here on this channel, that the markets are not pricing in any recession risk, is actually false. After a long time of thinking about this, we are pricing in recession risk in some areas. Some areas are not. This is kind of known, right? We've kind of already known this, but until we actually get that recession, those other areas, AI, is not going to price in recession risk because nobody thinks AI earnings are dependent on the economy, which I think that's false. I think if the economy slows down in a dramatic way or really any kind of way, yes, big tech will be affected. But until we know what's going to happen with the economy, the markets are going to give big tech the benefit of the doubt because valuations don't matter anymore. Now, this is actually inspired by this book here from Josh Brown. You might have seen him here on the channel before. It's called Secrets Every Investor Should Know. You weren't supposed to see that. And he basically talks about how almost all of the money coming into markets is passively invested at this point. And it's all being run by algorithms. Now, what these algorithms are programmed to do, because they are fiduciaries, okay? They are not allowed to invest in things that will make the firms more money. They have to do things that are designed for your goals, for your investment, goals. They are fiduciaries. This money's being passively managed. That's why you have all of these, index funds and the iShares, the Vanguard ETFs. This money's just coming in every week from paychecks or whatnot and just getting invested in the markets, regardless of valuations, because over the past 100 years, stocks have done well. Specifically, over the past year, stocks have done very well. The algorithms are not considering that once you get to a certain PE on markets, you should stop investing in markets, right? It's not taking valuation into the equation. So what's happening is all of this money is coming in every week, regardless of price. And that's why Apple, for an example, is where it is. Apple has really not grown in years, but yet the stock has done very well. It's because of this passive allocation into markets. It's the index bubble, as some people call it. Whether or not that is truly a bubble, I don't think we'll know for probably a long time. But that's one aspect of this whole valuations don't matter equation. It's all passively managed. The algorithms say investing in stocks over the past 100 years has been a good idea. You should continue to invest in stocks. Now, yes, some money might start to go into bonds as the Fed starts to cut rates and yields are over 4%, but the vast majority of money is heading into markets because that's where the return has been over the past year, regardless of price, regardless of valuation. Josh Brown explains it in this book. Like 10 years ago when Steve Ballmer, former CEO of Microsoft, decided to buy, I think it was the Clippers basketball team. Everyone thought that was a terrible transaction. He paid like almost $2 billion for the team. Nobody thought it was worth that. People laughed at him, made fun of him. Fast forward 10, 15 years later, there is many more billionaires. There is a lot more money out there. And that is now seen as a, good investment. And this is really not because the team's much better or the business is much better. It's because there's more people that can buy it, right? Because if price is dictated off of what someone is willing to pay for an asset, then the more money you have, the more people with money, the higher that asset price can be, the higher the valuation can be because there is more potential buyers. Now, think about what's happened over the past couple of years. During the COVID pandemic years from 2020 until late 2021, there was essentially $4 trillion of free money spent. Josh Brown explains it here in this book. Even the PPP loans, 95% of which were forgiven and not paid. That was trillions and trillions of dollars. So there's all of this extra money out there. And there's the same assets. Okay, so I think that partially explains what's happened to markets. We've seen inflation in markets. That's kind of the bottom line. Inflation, reduces debt over time by inflating that debt away. That's why the government targets 2% inflation. But it's also boosted up asset prices. And it's to some degree like everyone has $100, but there's only one loaf of bread in the store. That bread's going to be a lot more than $2 a loaf, right? Same for any kind of analogy. So there's just a lot of money out there. And the passiveness of this market says, buy stocks. When stocks fall, buy more. And that's what even, Josh Brown says here in this book. He was trying to figure out in the 2010s and heading into 2020, why markets just continued to go up, why the red days were becoming so far and few between and corrections were coming far and few between. It's because of this passive investment style. Over 80% of money coming into markets, almost 90% of invested capital coming into markets is passive, just going into an S&P 500 index fund. And until there is a reason for these algorithms to question the longevity of the US economy, then you're not going to see anything different than what we're seeing now. And we can all say valuations are high. We all know that. Old ways of valuing markets are high. Not this new era that we have where 40% of money was printed basically overnight in the past couple of years. This is a different dichotomy that we live in. The dynamics of this economy and markets have changed. That's a fact. So even, money managers that talk about the historical valuation of markets, they're all wrong. I have been wrong this entire time because the dynamic has changed. Now, I'll get into if markets will come down, if I'm still a bear, if I'm buying more stocks here or what I'm doing. But I think that's the central premise. It's all changed. Valuations investors would have balked at and said that's a crazy price are no longer crazy prices because people are willing to pay them. And maybe it's in fact that AI is just such a large opportunity that the markets will really not come down in any kind of material way until AI rolls over, until AI demand goes on a bit of a pause, which who knows when that is going to happen. And that's really because your largest companies in the S&P 500, they're the ones that are benefiting from all of this AI. Now let's specifically talk recession. Hard landing, soft landing. I think some of the same dynamics that are in markets, the fact that corrections are becoming rarer, 20% bear markets are becoming even more rare over the past, 20, 30 years due to some of this rise of passive investing and index funds. I also think that has had an effect on the economy as well. The economy has become more resilient. And think about recent memory. Think about in the past 25 years, exclude the dot-com bubble. The dot-com bubble was before a lot of these dynamics started, before, central banks were really stimulating, quantitative easing, before money printing just became a thing. You go into a crisis, just print your way out of it. The dot-com bubble was kind of the 90s logic. We are in a totally new regime. Okay, this is a different economy. This is a different market than 1999, 2000. Okay, 2008 really started all of this. But think about in the past 25 years, exclude the dot-com bubble. The only recession that we really had was 2008. Since then, we didn't really get any recessions. Yes, you had the COVID crash that was just scary overnight. People kind of freaked out. At one point, people thought the U.S. economy would be closed down for years and a certain percentage of the population would die, so on and so forth. You really don't have recessions anymore. And the recessions that we have had over the past 25 years, there has been something bad that happened. Something really bad that happened. Something that essentially broke. It was the real estate market in 2007. Without the real estate collapse in 2007, 2008, we probably wouldn't have got a recession. In fact, we would not have gotten a recession because the economy in 2007 reflects basically the same economy as we have today. Sentiment surveys, the federal funds rate, inflation, like all of the same data. You can basically copy and paste 2007 until today. The unemployment rate was like 4.7%. So in September, October of 2007. So it was a little bit higher than where we are today. But almost everything else looks pretty identical. Now, the question that I will ask you next is, are we going to have a catalyst? Is something going to break to give us that recession? And I don't know the answer to that. Okay. I think if the banking crisis were to happen today, that would be a catalyst. We still had a lot of, money out there in early 2023. There was the start of the, AI revolution in 2023 as well. That kind of, maybe the economy was just organically stronger in 2023. Who knows why we didn't go into a recession via the banking crisis? Maybe that banks were just confident, kept lending or whatnot. But unless there is some kind of big event, we may not go into a recession. Yes, I think the economy is going to slow. Of course, I think that's going to happen. I think that will have an effect on markets. I think markets will come down to some extent, 10, 15%. But they're not going to come down in any kind of big way unless we get a big event. And a big event on this kind of scale is like a black swan event. And I don't think that's going to happen. I don't see anything out there that would say there's something really bad coming, unless Nvidia were to like miss on earnings, AI demand just dried up, but that's not going to happen. Now, a lot of my argument against markets today, or really over the past couple of weeks, the last month or two, is markets are mispriced for the risk out there. Okay, that has been my central topic of thinking. But the more I think about passive investing, this new dichotomy that we have in markets, where old ways of valuing stocks are dead, they're gone. $4 trillion of funny money will do that. Passive income or passive investing will do that. The rise of retail investors will do that. I don't think really any of the same comparables to any other time in history can compare to this moment in time right now. Now, yes, are markets generally mispriced? Yes. But the reason they are mispriced is because Wall Street thinks if we do get a slowdown, big tech will not be affected. And that could very well be true. If we get a recession, big tech will be affected. Okay. If we get 08 again, or something even half of that, big tech will be affected. Okay. Is that going to happen? I don't think so. Has the economy historically just slowed into a recession? Just organically just slowed down and went into a recession? Not in the last 25 years. It hasn't happened. And again, I think the dichotomy has changed after 2008 with stimulus and all these measures that were previously like unthinkable that the government's willing to do, and overall resiliency of consumers. People spend money. That's what people do. In America, we spend. People spend. So if AI is not going anywhere, if investments in AI are not going anywhere, if old ways of valuing markets are no longer applicable, then markets may actually be appropriately priced. Because yes, there is a risk of a recession. The areas of the markets that are vulnerable to the economy have priced that risk in. Again, cyclicals, Dollar General, CVS, storefronts, Nike, consumer discretionaries, again, cyclicals. Interest rate sensitives have also been hurt via the Fed keeping rates higher. Well, if the AI areas of our markets will not be affected unless we go into a more steep slowdown, a deep recessionary environment, then maybe markets are appropriately priced. Because the odds of a organic just slowdown recession are not that high. Now, what really gets me rethinking a lot of my bearish thesis is what happens when the Fed does lower rates, when inflation is the reason why the Fed lowers rates, assuming the economy holds on and continues to do okay. Now, it doesn't have to do great, just has to do okay. If the economy does okay and the Fed is able to cut rates multiple times over the next coming years, then I think the way that we look at markets is really flawed. Because a lot of what this book says is treasury yields don't cut it. 60%, 65, 70% of baby boomers, well, people are living longer, say that number one. So even locking in a 4% 10-year treasury yield, treasury bond, doesn't cut it. You got to be invested in equities. So what happens when or if 10-year treasury yields do come down and you're not even getting 4% anymore? Perhaps you're getting closer to 2% again. Then there's really no other choice but to put your money in stocks. And especially as the Fed does cut rates over the next 12 months, money market funds are going to start paying a lot less. And that's going to prompt even more money into markets. And then just imagine that. Just imagine if the federal funds rate does, fall back to, let's say, 3% if that's the neutral rate. And there's even more ability of borrowing and less options to invest your money for, let's say, yield, right? Treasuries, things like that, credit. And there's more money flowing into markets. With the current dynamic that we have, that could push things a whole hell of a lot higher. And then you have Wall Street that's just lowering earnings estimates ahead of quarters. So it looks like we're just beating handsomely on earnings, even though the bar has been lowered so far, the companies beat. And that's what sends stocks higher, when companies beat on earnings. It's going to be very surprising if this is a bad earnings season. Let's just put it that way, because the earnings estimates have fallen so much. But stocks have not reacted negatively to the fall in earnings estimates. They are reacting positively to the beating of those lower expectations. Now, take a listen to this clip from CNBC that I showed you in the beginning of this video. And then at the end of this video, I'll wrap this up with my specific thoughts, near term, longer term for markets, what I'm doing, where I'm investing right now.
Thinks the S&P could hit 6,000 before the election. Joining us now is HSBC Chief Multi-Asset Strategist Max Kentner. So you see the good times going here. Why?
Yeah, good morning. The good time's still rolling. I think when we look at the earnings expectations for the S&P 500, when we exclude the seasonal bump in utilities, for example, actually consensus expects earnings to contract quarter on quarter in the third quarter. In a quarter where, for example, the Atlanta Fed's GDP now is saying that real growth has probably been 3.5%. So we're talking sort of nominal GDP growth around 6% most likely in the third quarter, and yet consensus expectations are for a sequential decline in earnings expectations. So in other words, put it simply, earnings expectations are way, way, way too low, way too pessimistic. And I do think that means the next couple of weeks, a bit of an upswing, particularly driven by the cyclicals and stocks. The reversal of what we had in Q3, not buying the bond proxies, not buying defensives, but really rotating into these cyclically and economically sensitive stocks.
I'm just thinking about what could go wrong in this kind of very benign economic environment, Max, and that is we've seen this creep up in bond yields as the economy has come in strong, so that's good news, but not good news if you were hoping and praying for Fed rate cuts, which might start to get more priced out.
Yeah, 100%. I think for now, it's still the good kind of reflation. For now, it's still the good kind of increase in yields. There will come a point, I think, where that will flip, just like we had in April this year, just like we had in the fourth quarter last year. Remember sort of September, October last year when yields hit 5% on the 10-year, or like we had a couple episodes in 2022. The point now is we need to try to figure out really that threshold, that point when it starts to become painful for equities, for credit spreads, for emerging markets, really for risk assets across the board. Now, we do think is what we call the danger zone. We analyzed that at the start of the year, and we do think that is more likely around 440 to 450 in the 10 years. So there is still around 35, 40 bips to go until really that pain zone, that threshold where really it will start to suffer until that really arrives. So there is an awful lot of room still really for equities to go higher until valuations will start to feel a pinch.
And again, I will go back to the point. This is a new dichotomy. The dynamics have changed. 2020 started that. And if we're looking at historical valuations, yeah, somebody 50 years ago would have said, no way am I buying this market. Somebody 25 years ago, maybe not then because that was a dot-com bubble, but in the 90s, someone would say, hell no am I buying that market. But everything has changed. And the reality that a lot of people on Wall Street are living in is not the reality that we face today. The rise of passive investing, where money goes out of your paycheck at your job to fund your retirement, that goes to a Vanguard fund that gets invested into the S&P 500 every week, every month. It's going to take something really bad to derail that, to get people to stop contributing to their retirement accounts, to get algorithms to change their fiduciary role to let's not buy stocks that have outperformed bonds forever. Let's buy bonds instead. It's going to take a lot to change that. And minus any exogenous event, I don't think that's going to change. Now, in conclusion, I do think there will be corrections. There will be periods where markets get fearful. I do think the economy will slow from its 3.5% GDP pace that we're running at right now. That's going to give the Fed room to cut. That could give you a correction, of course. But are we going into a recession? I've never been in the recession camp. I'm in the camp of it's too soon to know. I think if we can get to April, that we will know. April's the month of April. I want to see the economic data for March. March is typically after that holiday season where you tend to get a lot of crashes. Think about the '08 crash, that really happened in March. Think about the COVID crash, that really happened in March. The .com crash, that really started in March. March is the springtime is a very important time of the year. If you're going to, flip on sentiment, if things are going to change, if the narrative is going to change. So, yes, I think things will slow. I think there will be a period to buy stocks at cheaper prices. But I don't think the AI narrative is going anywhere. I think that's going to hold up the markets to the point you're not going to see a 20% or bigger crash. And I think the areas that have already priced in this recession could be the areas to benefit most if we don't actually just tiptoe into a recession, which has not happened in 25 years. Okay, so those are the areas that I really like. Something like an Applied Digital, for an example. If you want to take a little bit more risk, they're building data centers. They help with the IP of setting up data centers. I think that offers a great risk to reward. If you have a longer time horizon, if you want to take a little bit more risk, Applied Digital could be great in this new market. Especially a new normalized market that we could see in 2025. It's very well a possibility. We do have a soft landing and rates do fall as inflation falls and there's more money going into markets, which sounds crazy. There's over $6.5 trillion in money market funds that will eventually make its way into stocks. And I think the areas that will benefit most from that are the AI adjacent companies, data centers, software of AI, those names. And then you also have the cyclical rebound, as that analyst was explaining. As it looks like we're not going into recession, your cyclical areas will outperform. Dollar General, Nike, consumer discretionary, right? The companies that are beaten down right now. But do I think the coast is clear? No. Do I think we're going to walk into a recession? Probably not. So what does that mean? There will be a better chance to buy markets. If most likely, if that's what you're looking for, the economy will slow down at some point. Question is, does it rise to 6,000 or 6,200 and then fall to 5,900 and we're basically buying markets where we are today? That's hard to say. I do think there will be corrections along the lines of the next couple of months. But there are more powerful forces at play that most of us even realize, myself included. I was kind of overlooking the whole passive nature of 350 million people investing in their retirement accounts every week, every month. That in and of itself is very powerful, let alone all the money printing that has happened. Valuations, nobody cares. It doesn't matter when you have money just flowing every week, every month, passively. And as long as companies keep growing and those valuations keep chasing each other, I don't think we're going to get this doomsday scenario. But I don't know. These are just my thoughts. Let me know what you think down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Have a safe weekend, and I will see you in the next one.